All right. Welcome back to the next class on determination of adjusted profit. Right. So I've had some quotes here, which is basically to like motivate you guys. And I say here, it's not the beauty of the building you look at. You should rather focus first on the construction of a foundation that will stand the test of time. So you are looking at all these big, beautiful buildings, beyond the physical appearance that we are seeing. If there's any small earthquake or a small natural disaster now, these things will come crashing down, right? So building a very strong foundation is what matters the most. And let's take our eyes off the building. Let's take it to the task completion we are talking about. So what I'm trying to say here is that we might have known some things in our maybe previous work experience, might have known some things regarding how to prepare for IT computations. But this time, our goal is that we want to build a solid foundation so that we can know why we are doing some things that we do, why we allow some items, why we disallow some items, and why we should always have the law as our backup in every kind of instances we are making or scenarios we are making when it comes to company income tax variation. So under the adjustment, determination of adjusted profit, we'll be looking at the following. We'll be looking at taxable income. We'll be looking at profits exempted from tax. We'll be looking at deductible expenses. We'll be looking at disallowed expenses. Then we'll be looking at computation of adjusted profit, which is our main goal. So why are we looking at all these things? We are looking at all these things because they are the important steps required for us to arrive at our number 5 item on this list. So we'll kickstart by looking at each and every one of these items now. All right, taxable income. So for you to determine your taxable income, you have to understand the requirement of the law, which is section 9 of CETA. So I've extracted it here so that we'll not be going back and forth, right? I've extracted it here, and subsequently, we can all go back to watch the videos at our convenient time. So, charge of tax, subject to provision of this act, the tax shall for each year of assessment be payable in the rate specified in section 40, subsection 1 of this act. Right upon, so I don't want to read everything to you, but I want you guys to know that these are the taxable income that you can subject to CIT. So looking at 1A, it says any trade or business for whatever period of time such trade, okay, any trade or business for whatever period of time such trade or business may have been carried on. So if you do a trade or business in Nigeria, irrespective of the period that the trade have been carried on, right, you are expected to subject such to your corporate income tax, especially when it is a corporate entity. It is part of your taxable income. Number two, we have rent or any premium arising from a right granted to any other person for use or occupation of any property. So, in simple terms, where you have rental income, right? And some of us that did did CIT and another thing, we would have learned some of these things. So they call them taxable incomes. So we have income accruing from trade or businesses, income accruing from rent or rental income, rental properties. We have income accruing from dividend, interest, royalties, discounts, charges, or annuities. We also have any source of annual profit or gain not falling within the preceding categories. That is, if you have any form of annual profit, maybe coming from anywhere else aside from the ones you have mentioned above, then such should also be categorized as a taxable income. Now, section D says that for the purpose of this act, interest, including compensating payment received by a borrower from its approved agent or lender in regulated securities lending transaction, provided that underlying transaction give rise to the compensation payment, is a receipt of interest by a lender, blah blah blah. So basically, what I'm just trying to tell you is that sometimes when you see a particular item, there might be conditions to the reason why you should not allow as a what's it called? Why you should not allow as a taxable income. That is why you should exempt it as an income. But irrespective, any income that accrues to the business, first of all, treat it as a taxable income. That's just the summary I'm going to give you. Any income that accrues to the business, first of all, treat it as a taxable income. Then you now determine subsequently whether it should be exempt income, right, for CIT purpose, which you will see treat subsequently, or whether you should allow it as part of your income for the period. So subsequently, we have any amount deemed to be income or profit under the provision of this act with respect to any benefit arising from a pension, provident fund, and personal. So I don't want to bore you guys with all this storyline, right? But section 9 of CETA talks about taxable incomes. So we can all go back and read them subsequently. Then we have profit exempted. Profit exempted. So section 23 of CETA talks about the profits that are exempted from company income tax. That is company that profit that will not be subject to company income tax. And like we've briefly looked at it before, we have the profit of any company being a statutory or registered friendly society. That is, like I mentioned, clubs, right? Societies in schools, boys scouts, girls guides. So we also have profit of any company being a cooperative society. That one to discuss them briefly in the last time. We also have the profit of any company engaged in ecclesiastical, charitable, or educational activities. So we've also dealt with this. These are churches, mosques, schools, and the likes. This is why their profits are exempt from CIT. Now, don't forget, to the extent of the profit not being derived from trade or business. So they believe that those companies are providing, or what we call it now? We call it ecclesiastical services, right? So in that case, those kind of profits are not subject to CIT. But where it is purely kind of a kind of trade arrangement, then the profit will be subject to CIT. So we also have profit of any company formed for the purpose of promoting sporting activities where such profits are only expendable for such purpose. Then subject to such condition as the service may prescribe. So those kind of profits too are exempt from CIT. So profits from trade unions registered under Trade Union Act, those ones too, because they will be taxed under the Trade Union Act, so they will not be subject to CIT. We have a lot of them more, but I think there's one that I would like us to also look at. Okay, let me see if it's covered here. Okay, so see K says that dividend, interest, rent, or royalties derived by a company from a country outside Nigeria and brought into Nigeria through a government approved channel. For the purpose of this section, government approved channels means the Central Bank of Nigeria, any bank or other corporate bodies appointed by the minister as authorized dealer under the Foreign Exchange Monitoring and Miscellaneous Provision Act or any enactment replacing that act. So what this simply means is that dividend, interest, rent, royalties are exempt if they are brought into if they are derived from a company outside of Nigeria. So, and the reason why they are exempt is because in the first place, such would have passed through withholding tax. So, right, so it's most likely that they've been subject to withholding tax. And don't forget, we said withholding tax on franked investment incomes. Frank franked investment income, withholding tax on such are final and conclusive. That is, that will be the final tax on such income. So that's why they are no longer subject to CIT, or they are treated as profit exempted from CIT in this case. So intermission, yeah, the rent principle. So the rent principle. I don't know. Is anybody familiar with the rent principle on this call? Let me see. Okay. Since we are recording, maybe I'll just ask questions later, subsequently. So the rent principle is just a principle that guides treatment of transactions under tax to help you to know whether it is wholly, reasonably, exclusively, and necessarily incurred for the business, whether an expense is wholly, reasonably, exclusively, and necessarily incurred for the purpose of the business. So this principle represents one of the fundamental principles used in determining if an expense should be classified as allowable or unallowable expense. If an expense should be classified as allowable or non-allowable expense. Okay, so we have the W stands for wholly once again, R stands for reasonably, E stands for exclusively, and N stands for necessarily incurred. So subsequently, section 24 of CETA, for the purpose of ascertaining the profit or loss of any company of any period from any source. So the section 24 talks about what are the items that are allowable. We also call them deductible expense for company income tax purpose. And the above implies that if an expense does not meet the above criteria, it will be deemed unallowable and added back to the profit before tax. So that takes us to the next section, deductible expenses. Deductible expense. So let me do a quick um what do I call it now? Quick quiz. So for people on the call, right? Based on what we have discussed so far, let me see. I think this is like okay. Let me see this. Okay, I don't want to give you guys the entire cheat, but let me confirm. We discussed on rate of tax, right? What is the rate of tax for a company that has revenue between um 20 million, 25 million, and 100 million? What is the rate of tax? Anybody? Just to see what we have done so far.
20%.
20%. Thank you very much. And what section of the law can we find that? If we can manage it. What section of the law? I mentioned it.
Section 40 of
Section 40.
CIT.
Thank you very much. Who is that? Who is that person? Okay, that's Lukman, right? You prefer your preferred name Lukman or Duro Wade?
Anyone, I use anyone.
Anyone is fine. All right. Thank you very much. Thank you. So yeah, that's very correct. So section 40 talks about the rate of tax, talks about the three different rates of tax, which is 0% for small companies, 20% for medium-sized companies, and 30% for large-sized companies. So thank you very much for that. It was just like a kind of way of testing what we have done so far. So yeah, I also mentioned a particular section that talks about charge of tax. Charge of tax. That was like the first thing we looked at. Anybody to quickly recap that? What section of CETA is that? So let me just give us hints. It's section 9. Section 9. I also talked about taxable income. Taxable income. Before we came to this next place, the slide before this slide, taxable income. What section of the law talks about taxable income?
Section 9 talks about taxable income. Section
Mm, are you sure? Okay, somebody wanted to talk again. Tijani, you want to say something?
9. Yeah, I said for taxable income, you said section 9 of the CETA talks about taxable income.
Okay. Who else? Let me allow somebody else to try again. All right. So that's not correct actually. So let me quickly do something that I did for some people that I did last time. So this is it. Taxable income. Even though I gave you section 9 here, section 9 talk about the charge of tax, right? And it explains the taxable income. But it's not like section 9 is the taxable income itself, right? I'm just using this particular slide to explain the taxable income. That was like a test to see whether um you guys are following. But anyways, it's not like you are not correct actually, but just like to reinstate that section 9 is actually charge of tax. So if you go to because if you go to your company income tax act, you won't see it written as taxable income, you see it written as charge of tax. Do you get that? So just for the purpose of learning, let's take note of that. Then I also did something here. I made it quite easy for us. So when we are looking through, you will see that I wrote taxable income. No, I didn't put the tax law here. We have profit exempted from tax. We have deductible expenses. We have disallowed expenses. Then we have computation of adjusted profit. I've put all the relevant tax laws here. So let's move on. Thank you very much, Tijani, for that question, for that answer rather. So everybody's answer is actually on point. Now, intermission, the REN principle, we've talked about this. Now we are going to the deductible expenses now. So deductible expenses are addressed under section 24, section 25, and section 26. Section 24, section 25, and section 26. So this material will be made available to everyone after the call. So so that we can easily go back to it if you want to make reference to it. So under section 24, it focused more on deductions allowed. Deductions allowed. Now, because when we are preparing our CIT computation, right, from accounting perspective rather, we would have done some revenue minus cost of sales minus this minus that plus. So okay, let me just give you a kind of rundown. That revenue minus cost of sales give you your gross profit. Your gross profit minus operating expenses or admin expenses or finance cost plus finance income minus other plus other income and all those things gives you your profit before tax, right? Now that profit before tax that you want to come and bring into your CIT to determine your taxable profit or to determine your actual tax that you bring into your CIT computation. The profit before tax, from tax perspective, it is believed that that profit before tax is not correct. So the tax person or the tax authorities only want to see actual expenses. Actual expenses. They don't want any kind of provision. They don't want any kind of estimates. They don't want any kind of um, adjustments that are not actual expenses. So they want to see the actual expenses for the year. So that is why they now say, okay, these are the deductions that are allowable for you to be able to know that, okay, after my gross profit, oh, these are the items that are allowable for me to deduct for tax purpose. And that is why I always say that a tax person usually knows how to prepare financial reporting more than or they know the kind of languages to use when preparing your CIT or preparing your FS as compared to normal person that's preparing your accounting informations. So we have the deductions allowed, so that I won't digress too much. Deductions allowed. Let me see how long we have been recording this. So maybe I have to break it. Maybe after this place, I'll break it for the purpose of those that might want to record to watch it later. So we have the deductions allowed. Um, Under section 24, talks about subject to provision of 7th schedule of this act, any sum payable by way of interest on borrowed debt and employed as capital in acquiring profit of a company. So what this is simply saying is that, well, there is a kind of restriction under the seventh schedule, which talks about interest on certain loans and borrowings, right? But in this case, it's just basically saying that if you incur interest on debt, and that debt finance is the one that you use to finance the business itself, then such interest will be an allowable deduction. That is, you can allow it to pass as a deductible expense. Now, it's also saying that rent for that period and premiums. So, for and liability for the liability for which was incurred during that period in respect of land or building or occupied for the purpose of acquiring profit. So rent, lease, leasehold payment, and all those things, right? They are allowable expenses for income tax purpose as long as those rents are incurred for the purpose of acquiring profit. So rent of your CEO or rent of your MD is a disallowable expense. It is only the rent that relates to the business itself that is allowable expense. So rent for expatriate, they are disallowable expenses. They are not only for the businesses. Well, except you can justify that they are for businesses, then maybe it might fly. So we also have any outlay or expenses incurred during the year in respect of salary, wages, or remunerations paid to the senior staff and executives. So once it's 12:30 or 12:30, that's 2 minutes time. I'll just give us a kind of 10 minutes break or 15 minutes break for everybody to just, some people are having, I've seen somebody's chatting me up that if there be break. Okay, so once it's, let's say, sorry, I said 12. Once it's 3:35, 3:35, we can go on break. Then we'll convey back in like 15 minutes time. Yeah, thank you. So, deductions allowed. We have, we've talked about interest expense, we've talked about rent, we've talked about, okay, so now we are going to end section D, section 24D, which talks about any outlay or expenses incurred during the year in respect of salaries, wages. So salaries that you pay, your wages that you pay to your employees, they are all allowable expenses. So in simple terms, 20 section 24 is allowable expenses. That is also the same thing as deductions allowed. So it also further went to say that any cost to the company of any benefit or allowances provided for the senior staff and executives, which shall not exceed the limit of the amount prescribed by the collective agreement between the company and the employee and approved by the Federal Ministry of Ministry responsible for labor matters. So what he's simply saying is that any amount that you give to your senior executives, maybe 13th month bonus, as long as it is documented, right, and it is not outrageous, then they are also allowable expenses. So salary to your employees, salary to your workers, they are all allowable expenses. Now we also have any expense section. If you look at 34E, any expense incurred for repairs of premises, plant and machineries, furniture and fittings, employed in acquiring profits, or for the renewal, repair, alteration of an implement, utensils, and articles of blah blah blah. So what he's trying to say is that any expenses that you incur, right, in the business, that of course, taking us back to the rent principle, once it is wholly, reasonably, exclusively, and necessarily incurred for the business, then such expense is expected to like be an allowable expense, right? So expenses such as repair and maintenance, utility bill, transportation expense, all those kind of things, right? As long as they are wholly for incurred for the businesses, then they should be an allowable expense. We also have bad debt. Of course, you can't avoid bad debt. If your customer buys something from you and say, I will pay tomorrow, then first day pass, second day pass, third day, 1 month, 2 months, 1 year, 3 years, the customer cannot pay again. So if in case the customer cannot pay and it becomes a bad debt, the tax authorities are reasonable because it has become a bad debt, then they can allow it. However, there's a condition to it. It says bad debt incurred in the course of a trade or business okay, bad debt incurred in the course of a trade or business proved to have become bad. Okay, sorry, let me read that again. Bad debt incurred in the course of a trade or business proved to have become bad during the period for which the profits are being ascertained, and the doubtful debts to the extent that they are respectively estimated to the satisfaction of the service to have become bad during the said period, notwithstanding that such bad or doubtful debts were due and payable before the commencement of the said period. What this simply means is that doubtful debt, as long as they relate to the particular period, right, then they are allowable expenses. But don't forget, they must also be specific bad debt or doubtful debt. When it is general, then it might not be allowed. General in the sense that you pick bad debt from this place, everything, just lump everything together. From your ECL, from your internal loan that you gave and everything, just made everything to become bad debt. No, it's always good to specify, is this bad debt coming from my receivables, right? Is it as a result of pilferage? So if you can specify what the bad debt relates to, then I think you are good to go when it comes to allowing or disallowing such bad debt. So moving on, section 27. So section 24, 25, and 26. Now, I've only extracted section 24 here. Let's quickly see the tax law. Since we still have like 2 minutes more, let's quickly see the tax law for section 25 and 26. Just a minute. Okay. All right. So you should be able to see my screen now. So section 24 again. This is it here. Let me run you guys through again. So we have the deduction allowed, which is we have the interest on borrowings, we have the rent for the period, we have salaries and wages and directors fee and all those costs to senior staff and executives. We also have any expense or repairs of premise, plant and equipment. You have bad debt, provided that, of course, there are specific bad debts. Then we have contribution to pension, provided that um, those such contributions are, like, of course, for the employees. Then we have what else? So we have also other expenses or liabilities incurred during that period, as long as they are only reasonably excluded for the business, and such are allowable expenses. Now, we also have dividend or monetary distribution made by a real estate investment. You have compensation payments, that is gratuity and the likes, right? All these are allowable deductions as long as they relate to the specific business that we're talking about. Now, we also have the section 25, which talks about deductible donations. Deductible donations. Don't forget, section 24 talks about deductible expenses. Section 25 talks about deductible donations. So I want to just finish this part before we go on the break so that we won't miss anything. So deductible donations, basically donations that you give out to your employees, donation you give out to the public, donation you give out to the government in some instances. So what are the guidelines surrounding them? So you say that subject to provision of this section and notwithstanding anything contained there. So any amount, right, for the purpose of ascertaining profit or loss of any company for any period that is source chargeable, blah blah blah, there shall be deducted the amount of any donation made for that period by the company to any fund, body, or institution. So we say that number one, you can deduct, you can allow the deductions in terms of donation that is made from the company to any fund, body, or institutions in Nigeria to which section applies. Now, that was further explained. It says, without prejudice to section 27, which talks about this. Of course, section 27 talks about disallowable expenses. So It is hereby declared that for the avoidance of doubt, a provision of subsection 1 of this place shall have effect, but only if the donations are made out of profit of the company and are not expenditure of the capital nature, right? So it gave us some instances. It said they shall be excluded from some allowable deduction, blah blah blah. So it says the section shall apply to public funds, that is, donation that you made to public funds, donation that you made to statutory bodies and institutions, donation that you made to ecclesiastical, charitable, benevolent education established in Nigeria, which are specified in the fifth schedule of this act. So you can go back to fifth schedule to understand more, but of course we'll still get there. Then we have the minister may by order in the Federal Gazette amend the said schedule in any manner whatsoever. So it also further gave us donation made by a company in cash or in kind, set up under the federal government. So these ones are also talking about other donation made to the government, right? Then also talks about the COVID-19 aspect too, as it says under this part, you see that it says notwithstanding provision of section 2 and 3, amount allowable for okay, these are amount allowable for deductions in respect of subsection 8. So subsection 8 here is talking about donations that are being made to the government with respect to certain ministries, right? It says donation made by company in cash or in kind to any fund set up by the federal government or state government, or to any agency designated by the federal government, or to similar fund or purpose. So sometimes the tax law can be very boring because of this too many grammar and English, right? But in summary of this paragraph, what he's saying is that any payment you make, let me read this first three lines together. That is what he's saying. Any payment you made to the government in respect of any pandemic, natural disaster, or other exigencies shall be allowed as deductions as follows. So if you remember during COVID-19, some companies were saying that we gave government 1 billion, we gave government 10 billion, we gave government 2 billion, and then they will come back and say they want to deduct such expenses from their profit. Imagine a company that made a profit of 20 million, right? And they said they gave government 19 million for COVID-19 palliative. So at the end of the day, they will have 1 million taxable, or they might even be in loss making position sometimes. So the government is now sometimes you say, no, we don't want you to say because you gave donation to the government, then you don't have any tax payable or you don't have any taxable profits. No. So they will now say that they now came back here and say, notwithstanding the provision of this subsection 2 and 3, amount allowable for deduction in respect of subsection 8 above in any year of assessment shall be limited to 10% of accessible profits after deduction of other allowable donations made by the company. So what he's simply saying there is that total donation in that instance that you made to, let's say, government in the case of natural disaster, pandemic, and the likes, they shall be restricted to maximum of 10% of the accessible profit after deducting every other donation that you have made. So what it simply means is that the government is also trying to safeguard its own income, despite the fact that you are saying you want to contribute to the government. So don't worry, as time goes by, you guys understand some of these things more. When we start doing the practical session, I will have different scenarios to it, then we can all answer it together. So section 25A, section 25A, these are still part of it. You can just read it up. Then we have section 26, deductions for research and development. So deduction for research and development, these are also part of the allowable deductions, right? It's just trying to like tell you that, okay, what are the things that the government allow, what are the ones that they disallow, right? Then okay, so because of our time, I'll just quickly do a kind of break for us. Let's go on a 15-minute break, so that we can all go and refresh, and then maybe we'll come back by okay, this is 3:40, so let's come back by exactly 4 p.m. 4 p.m. So during that time, um, if you have questions, I'll be on the call actually. So if you have questions, if you have any inquiries, just quickly reach out to me. I will be able to answer you on the call. Yeah, thank you very much. So let's have a short break, and then we'll come back to come and continue our presentation on the legal framework for company income tax. Thank you. All right.